Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Good morning, everyone, and welcome to Tax Tuesday. My name is Anthony Wolfenden. I'm a tax financial advisor, and I'm here this morning to share the third phase in a discussion on capital gains tax that we started a few weeks ago. And I wanted to talk about a sneaky little tax the ATO doesn't tell you about until they send you a bill. And it does typically hit many people who sell property and make a capital gains tax. We want to go over it a little bit. It's one of the div taxes. These are the sneaky little ones that the ATO adds. This one was actually introduced in the 2012-13 tax year. And it had a threshold for income of over $300,000, which didn't impact too many people, so not many people paid attention. In the 2017-18 year, that threshold was dropped to $250,000, and the threshold's an interesting one. We'll get into how the tax is calculated shortly, but the tax is called Div 293. Div 293 tax. It will impact any really high income earner and potentially anybody that has a capital gains tax for selling property. And it's just a little added one that you'll get notified with after your taxes are done. They'll send you a bill for some extra money. So how does Div 293 work? Well, it was designed, as I said, in 2012, 2013 to make the superannuation system more fair. And what they do is they look at an income calculation that they'll make. Wait till I tell you how that's done. That's quite interesting. And they look at your super contributions, and you may be liable for this tax under if two circumstances are in place. Number one, if you've made a concessional superannuation contribution for the year, that's what's taxed. So you have to make one, otherwise there's no tax at all. But most Australians do, because concessional super contributions include salary sacrifice, they include superannuation guarantee from employers, and they include any personal tax deductible contributions you make. That's the up to $30,000 you can put into super every year. That's the amount that's already taxed in super by 15% when you put the money in. And basically, Div 293 is a way of the government saying, hey, you're actually making really a lot of money. And I guess we'd like to share in that benefit. And so when you use superannuation contributions and you earn a really large amount, and we'll figure out that calculation in a minute, we'd like you to pay an extra 15% on your super contributions. So you have to have made super contributions. And then number two, you have to have income calculated. It's called Div 293 calculation that exceeds $250,000 for the year. And that includes the superannuation contributions. So think about it for a minute. The way we normally do, for instance, taxable income, you add up all sources of income, you take off all your tax deductions, which might include superannuation contributions and all that sort of thing. And that's how your regular tax is calculated. Taxable income is salary plus other income minus all of your deductions. Div 293 doesn't actually work that way. For Div 293 purposes, the government looks at what you'd have for taxable income. They then add on top of that any fringe benefits you might have. They add on any financial investment loss. Think about that for a minute. Loss usually comes off income. No, they add it in. They add in any rental property loss. That's considered part of Div 293 calculations for how much money you've made, interestingly. They add on any family tax, discretionary tax, discretionary trust distributions that you've had. They add in any superannuation contributions you made concessionally. They add that all up. And if that total amount of stuff exceeds $250,000, and if you've made any superannuation contributions concessionally for the year, including those from an employer, you will receive a bill for Div 293 taxes. This is, as I said, really, really quite lovely. So the calculation is done like this. They will tax you on how much your income exceeds that threshold. This is Div 293 calculation. So everything we've just talked about added up. How much does that exceed $250,000 by? Or your total contributions for the year, which could be up to $30,000, whichever is less. Whichever is less. Okay. So I got to sort of wrap this all up in my head. That's a whole bunch of stuff. Probably the easiest way to think about it is if you've made a really, really big capital gain for the year and you earn relatively well, it's very likely that your Div 293 calculation is well in excess of $250,000. That's very possible. It happens all the time. And so the way to work out what you're likely liable for is to look at your total contributions for concessional contributions to super for the year and calculate an additional 15% tax. So as an example, and this is worst case for Div 293, if you've earned really well, if you've made a massive gain, if you go to contribute money to super, you've thought about it and you really like the idea of a $2 million tax-free income at 60, asset at 60 to draw a great tax-free income, if that's part of your goal, you may be putting $30,000 into super every year. And so worst case under those circumstances, 15% of the $30,000 contribution will be $4,500. So Div 293 is a tax that you'll be notified about after your tax return is done. They need all that information to calculate it. And if your income exceeds 250, including gains, plus any losses, plus superannuation exceeds 250 by a good amount, they'll tax you on the superannuation contributions that you've claimed a tax deduction on already, and they'll charge an extra 15%. So your super contributions are taxed at 30%, not 15. Your super fund's taken out 15. The government will ask for an extra 15%. So very, very worst case, the most you can ever pay is an additional $4,500. They will be nice about it. They'll send you the bill. You can pay it personally. You can actually release money from super to pay it as well. They'll charge you interest if you don't sort it out, and you'll get this notification as an email, a notification from the ATO. So look out for Div 293. Nasty little sting in the tail, an extra $4,500 in a tax year where you've made a good gain. Now let's go over any ways to duck it. None. because tax-deductible expenses are usually added back for the calculation. So it's very, very difficult to avoid. You are going to get hit in all likelihood. So let's talk about who's exempt, because this was something interesting. All of this comes from the ATO's website, so please feel free to go and check out Div 293 there. There's a specific section of legislation that was introduced, Div 293 for high-level office holders. So if you happen to be a minister or of the government of a state, if you happen to be a member of staff for a minister or a member of the government of the state, if you're a member of the staff for a governor of a state, if you're a member of parliament for a state, if you're a clerk for the House of Representatives, if you're a Commonwealth judge, you don't have to pay. Congratulations. Being in the public service apparently does pay well, and you get to duck it. So one of the lovely, not very fair things that's introduced is the people who put the legislation in made sure they protected themselves from it, but the rest of us get hit. So still makes sense to contribute potentially money to superannuation to reduce your overall taxes. If you've made a big gain, remember you will be paying up to 47% of whatever the gain is for calculation purposes. Contributing to super at 15% is obviously a no-brainer. There's a 32% tax difference there. But if the gain is big and you reach the Div 293 threshold, which is very easy to do, you will be taxed in super at 30% instead of 15%. There's still a 17% tax differential, not 32, but 17. So it's still worthwhile considering, but be aware when you make a wonderful gain on your property, you're likely to get a bill for an additional up to $4,500 in tax at the end of the year. Don't be surprised, please, guys. It's too easy to hit now, and that's just something to look out for. So that's a quick update on additional fun things the government comes chasing you for. Contributions in building a super is still a wonderful idea, but there might be a little bit of a bill along the way, notified after tax time. So that's it. Quick update for Tax Tuesdays on a sting in the tail when you make a capital gain. Certainly worth considering. Go look at the ATO's website and Div 293. If you can make heads or tails of it, well done. That's it. We'll see you in another week's time. Cheers.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.